The Fed has just thrown a massive economic curveball and has decided to once again halt base interest rates where they are between 5.25% and 5.5%. This is yet another delay to the rate cuts that many had been expecting at the start of the year, and markets are now predicting just 2 rate cuts for the rest of 2024. This is a sharp fall from the 5 rate cuts that were expected in January. However, those who have been following the wider economic data closely will no doubt not be too surprised by this news that rates are being halted in what looks to be a monetary policy U-turn by the Fed. Recent inflation data is very concerning and is showing signs of being nowhere near under control just yet, which is largely driving the narrative that the Fed may be forced to keep interest rates higher for longer. Now, this is a big problem because many institutions and entire industries have been struggling to keep their head above water during this high interest rate period and have been desperately waiting for rate cuts to begin. Now, the consequences of interest rates staying high for longer are therefore set to send shockwaves across the entire economy and could lead to things completely breaking. So inflation is one of the main driving factors behind this delay to rate cuts, with the latest data for February coming in higher than expectations at 3.2%, also rising from January's 3.1% as well. This is now 2 back-to-back months of rising CPI on a monthly basis and means that CPI is still yet to fall below the 3% year-over-year barrier. It has stayed sticky above this 3% threshold since June of 2023, well above the 2% Fed target, despite many people back then expecting it would just keep falling until it reached the 2%. And the forward-looking data doesn't look any better, with various economic indicators that have historically led CPI data signalling that there could soon be a new inflation surge. The Global Supply Chain Pressure Index is one of the best and most accurate leading indicators to show where CPI inflation is heading in about 6 to 12 months' time, as the index does track transportation costs and manufacturing indicators to get a gauge of global supply chain conditions. In recent months, we have seen the index spike up from the lows that were seen in May 2023, suggesting that there will soon be a surge in inflation too if this historic correlation remains strong. There is a lot of global conflict in the world right now, particularly in the Middle East, which is leading to stress on many supply chains, with shipping and freight costs seeing a significant surge in their cost. These rising costs are likely to be passed on to the consumer, and this data from a recent NFIB survey shows that there has been a strong uptick in the percentage of companies planning to raise their selling prices. This pattern that we have seen over the last few years of inflation being stable at the start, then surging, then falling back to being close to where it was before, and then starting to rise again, is nothing new, and in fact we are almost completely mirroring the inflation pattern that was seen in the 1970s. And you can see on this chart how this did eventually pan out. Inflation is far from defeated, and depending on how strongly we see the data rebound in the coming months, we are likely to see interest rates remain higher for longer, or even potentially rise even higher, depending on how out of control things do get. The banking sector is one of the biggest losers when it comes to high interest rates in this current economy, and is the sector that could have the most trouble coming its way in the prolonged high interest rate environment. Jerome Powell has literally said in his own words there will be bank failures, although he did add a disclaimer that this won't affect big banks. And he did say this a couple of weeks ago before the most recent bad CPI data did come in and the halt to rates was confirmed. Now, bad commercial real estate loans is the main source of trouble for these banks, particularly for regional banks who are more undercapitalised compared to large banks, however have been consistently growing their exposure to CRE loans over the last decade or so, to now holding 2/3 of all CRE loans. The Commercial Property Price Index is down over 20% since the peak in 2022, but specifically the office real estate subsector is down substantially more. 14% of all CRE loans are in negative equity, and this percentage rises to a staggering 44% for specifically office building loans. As a result of plummeting property values and interest rates remaining sky high after rising so rapidly, we are seeing commercial real estate loan delinquencies rise to the highest that they have been since 2014. And there are a wall of CRE loans that are set to mature in the coming years, with the underlying value of these loans being crippled by the current high interest rate environment. If interest rates are not cut anytime soon, then we are going to see more and more delinquencies take place across the commercial real estate sector, which is going to inflict more losses on these banks with high exposure. More losses, both realised and unrealised, is going to increase the fear and uncertainty amongst customers and investors of these banks, and could lead to bank runs in a similar fashion to what caused the collapse of the Silicon Valley Bank as well as several other banks in 2023. But it's far from just the banking sector that are going to be feeling a whole load more pain from these prolonged high rates, as the US government themselves is also going to be suffering the longer that this goes on for as well. Now, government expenditure on interest payments on their debt has exploded over the last few years and now exceeds $1 trillion annually, which is double what it was in 2020 and far higher than any time period in history. The government budget for 2024 is $6.9 trillion, which means that interest payments on debt make up a whopping 14.8% of all government expenditure approximately, which is an insane level. This makes it the fourth highest expenditure category, ahead of Medicare and income security, and right behind national defence, which it is set to overtake in 2024 according to a Congressional Budget Office report, and that was even before the readjustment for the interest rate staying high for longer and the increase that we have seen in government debt. Now, the CBO forecasts that the federal budget deficit will reach $1.6 trillion in 2024, then $1.8 trillion in 2025, all of which will need to be funded by issuing new debt in the form of Treasury bonds. Treasury bond yields correlate very strongly with baseline interest rates for obvious reasons, so the government will be forced to pay more money to these investors who are buying newly issued debt. And we know that this new debt is being issued at quite a pace, as just the other day, an additional $1.2 trillion spending bill was passed, contributing further to the out-of-control total public debt. The government is likely to also hike taxes to cover some of this rising expenditure and growing budget deficit, which is going to hit both corporations as well as consumers quite hard. Biden has in fact just released details on a new tax plan that includes over 100 tax hikes and changes that will increase tax income by a staggering $5 trillion. One of the big changes would be a proposed corporate tax hike to 28% from the 21% it currently is, which will suck an additional $1.4 trillion over 10 years from these businesses that are getting taxed. Now, other tax hikes focus on investment tax, capital gains tax, as well as tax hikes for high net worth individuals. Now, depending on how this extra tax income is used by the government, we could therefore see both corporate and consumer spending power weakened across the entire economy, leading to a weaker overall economy. And we know that a good portion of this tax income will be going towards the government debt bill, which is incredibly high right now and is only likely to keep rising as new debt continues to be issued. Now, higher corporation tax will hit American businesses and have knock-on effects throughout the economy, which includes less money available for growth and development projects. This is therefore likely to lead to less people being hired and could also lead to increased layoffs, both of which will obviously lead to upwards pressure on unemployment rates. And high unemployment will negatively impact all American citizens, not just the high earners who will be getting taxed directly as well. Many US consumers are currently crippled with debt, which is another way why these higher for longer interest rates are going to directly hit American consumers. Now, mortgage rates are likely to remain at the current sky-high levels, around 7% for the foreseeable future, and are currently at 6.87%, which is higher than the peak reached during the global financial crisis. This, combined with property prices still remaining very high, leaves the national payment to income ratio at 33.4%, meaning that US homeowners are losing a high percentage of their income every month to housing payments compared to almost all periods of history. Personal interest payments have more than doubled in the last couple of years to $573 billion, largely being driven by surging credit card debt and much higher interest rates on this debt. All of these things further contribute to weaker consumer spending power, which is going to keep harming corporate profit and performance until rates are lowered. Now, as mentioned, the banking sector is in really big trouble right now, and it's not just high interest rates that are causing this pain. There is an economic storm brewing that is starting to hit many banks across the US, and it could lead to a new wave of banking failures taking place in 2024. I cover this in more detail in my previous video, which you can check out by clicking on screen right now. But aside from that, if you enjoyed the video, please leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.